It can take months or years to save up $10, $20, or $50,000 to buy your next rental property. But even then, with housing prices so high, it can still seem hard to make it work with that amount of cash. But it doesn't have to be. I'm Chad Carson. People online call me Coach Carson, and in the 21 years I've been investing in real estate, I've bought a lot of rental properties with $50,000 or less out of my pocket. And in the rest of this video, I'm going to show you 4 examples of how you can do it too, even in 2024. And we're getting started right now. So let's start off talking about how much cash you actually need to buy a rental property. And if you're a new or a growing real estate investor, this can be a pretty intimidating topic because we're talking about properties that are $400,000, $500,000 or more that you're buying. And so there's a lot of costs that start adding up. You have your down payment, which could be anywhere from 5 to 25% of the purchase price. You've got closing costs. You have to pay the appraisal, the attorney's fees, all of those inspections when you buy the property. You've got holding costs. So if you have a property that's vacant and it's going to take a few months to rent it out, you've got to pay for those costs as well, and maybe some repair costs to get the property ready to rent. And then finally, I always recommend that you put up some cash reserves. So a minimum for me is about $5,000 per property, just so you could cover some kind of maintenance expense or heating and air, part of a heating and air expense if that came up. But you could also put a lot more than that. And so when you total all of that up, that's probably the reason you're thinking, I don't have enough cash to buy my next rental property. It's going to take me more time to save it up. So it's true that someone has to come up with that amount of cash. There are rarely true no money down deals in real estate. But here's the key unlock of this entire video. What experienced investors, those who are able to continue buying more rental properties, know is that you can use something called O.P.M. That stands for other people's money. So as I'll show you in these examples, you can sometimes work with a private partner, a private lender, even the seller to help you come up with the cash you need. But there's an important caveat. You probably know this intuitively, but there's no free lunch. There's no shortcuts with anything in real estate or life. And so for you to be able to get the money for your deal, you have to bring something of value as well, which means when you get a deal, it needs to be a good deal. And I talk a lot on this channel about what that means, but you have to buy a good property in a good location. You have to probably get it at a good price, which today probably means buying it below its full value, or you need to get really good financing terms. Maybe you borrow money at a lower interest rate for a much longer period of time that allows you to hold the property and make it cash flow. So the point is, you can get the money if you bring a good deal, and I want to show you how you can do that with these examples. So for our first example, let's imagine you're out looking for properties and you find a single family house that has a full value of $400,000, but you could buy it at a discounted price of $320,000. Now, of course, we're going to rent this property out. So let's assume you could rent it for $2,400 per month, and you're going to have some operating expenses. You have to pay taxes and insurance and maintenance, and the property might be vacant every once in a while. So let's assume you set aside $950 per month for those operating expenses. So when you subtract that from your rent, $950 from $2,400 in rent, you get a net operating income of $1,450 per month, or $17,400 per year. Now I'm going to be doing a lot of back of the envelope, or in this case, whiteboard math for these examples. But if you want a tool that'll help you run the numbers for your own rental properties and you can get it for free, I want to offer you a simple rental property calculator that I use. You can get that if you look below in the video description or podcast description, or if you're watching on YouTube up above me, you can click on a link to get that for free. So now let's look at how you would actually put this deal together, where the money would come from. So let's assume a bank would loan you 80% of the purchase price of the property. So that means you'd have to put $64,000 down and then get a loan from the bank for $256,000. Now, as I'm recording this in early 2024, investor interest rates are around 7.5% to 8%. So I'm going to use the upper number of 8% for a 30-year mortgage. So if you use any amortization or loan calculator on the internet, you can figure out that your monthly payment would be around $1,880 per month on that $256,000 loan. Now I want to pause here for a moment to look at where we are on this investment deal. First of all, someone had to come up with $64,000 down, plus let's just say another $20,000 in closing costs, maybe some repairs, maybe some holding costs. So that's about $84,000. But then let's look at our monthly cash flow. Remember, our property produces $1,450 in net operating income, and our mortgage payment is almost $1,900 per month. That means we have a negative cash flow of over $450 per month. So before we even go any further, remember we might have even had $50,000 saved up. So this is much more cash than we had to put up front. Plus we have a deal with negative cash flow. Is this something you just walk away from? Well, here's where the idea of other people's money comes in. In this case, I want to talk about using a money partner. Now, before I ever have a conversation with a money partner, I want to have a very clear idea for myself about my strategy for how to make money on this rental property. Because remember, there's no free lunch. There's no shortcut. If I'm going to ask somebody to put up the money for my deal, I need to have something of value to give them in return. And that means I need to have a good deal that can make money. So let me unpack how I might think about making money on this particular rental property. Now, we've already made it clear that we're not going to make a positive cash flow on this rental property, at least not with putting 20% down. We'd have almost a $450 per month negative cash flow. So the only way to make money on this property is by the growth. Both the growth in the price of the property and the growth in the rent. So over time, if the rent goes up, that negative cash flow will get smaller and smaller and hopefully eventually turn into a positive cash flow. And so this gets into the point of the different types of real estate investment deals you get into. On one extreme, you have cash flow deals where the reason you're getting into the deal is the amount of cash flow you're making on a monthly basis. This is typically in lower price markets where the ratio of the rent to price makes it easier to make a positive cash flow. And then on the other extreme, you have the high price markets where the prices are a lot higher than the rents. And the way you make money there is less about cash flow and more about growth. Now, I like to buy in markets where I can do both. But in this example, we're looking at more of a growth strategy property. So something I didn't get into, I'll be very particular about the location I bought in, both in the big picture, the region I bought in. I want to make sure that the population is increasing in this area. There's a lot of good job growth, that people are making a lot of money. And then I want to buy in a neighborhood that has a lot of demand. It's a place people want to be in, and there's actually a low supply. It's hard to replicate the house that I have right here. And then I'm going to be very particular about the type of property, the layout, the size. Now, all of that falls under the category of what's called a buy box for your investment property. It's a whole nother topic. It's actually something I did a whole nother video on where I shared my own buy box and how to build your own. So if you want to check that out, if you're watching on YouTube, you can click on the link above, or you can look in the video or the podcast description to check that out. But the point is, if you're going to buy a property where you're going to benefit and profit from the growth, you need to be very particular about the types of properties and regions you buy in so that you can have a better chance over the next 5 to 10 years of that property growing in value. And so in this case, let's just look at some rough numbers that we might share with a money partner. We're going to share that we bought this property, we're buying it for $320,000. And our strategy might be something I learned from one of my mentors, John Schaub, just to do a simple buy and hold where we're going to hold this rental property until what we paid for it doubles. So if we paid $320,000, we're going to hold it until the full value of this property is $640,000. Now, this is just a simple goal that encourages you to be patient. None of us really know how fast this property is going to grow. But if this market was a good growth market that grew at about 5% per year, it might take about 10 years for this property that's originally worth $400,000 that we bought for $320,000 to grow to a value of $640,000. And the way we make money is that we put $84,000 down, plus in this case, we might have a negative cash flow of about $5,000 per year. But then when we sell the property, we'll have equity, which is the difference between what the value of the property will be, $640,000, minus whatever our debt is on the property, which might have been paid down to about $225,000. So potentially, we would have over $400,000 in equity. Then we put up $80,000 plus some negative cash flow along the way. I'll also add that we bought this property with an 8% interest mortgage. So there's a good chance that over those 10 years, if the interest rates go down to 5 or 6%, we're going to refinance so that we can decrease our mortgage payment and not have as much of a negative cash flow. So the point is, we have a rough plan. We put in this amount of money and we get this amount of money out in the future. Like any investment plan, there's nothing guaranteed, but that's our strategy. One final wrinkle I'll mention about this money partnership in this particular example, for someone to come into a deal and be willing to fund the negative cash flow, obviously they have to have some deep pockets. Then you need to know that they have enough money to keep that going on an ongoing basis. What I actually might prefer when I'm putting the deal together is instead of asking them to do that on an ongoing basis, is just to make a bigger down payment up front so that you don't have the negative cash flow. So for example, you might put $130,000 down and then you still have another $20,000 in the closing costs, holding costs, and the reserves. So you have about $150,000 total that you'd be asking your money partner to put up. But the benefit of that is you'd be borrowing less money because you made a larger down payment. Maybe you only have a $190,000 loan instead of a $256,000 loan. And at 8% for 30 years, that would be just under $1,400 per month instead of the $1,880 per month. And so all that means is that your net operating income from the property of $1,450 would cover your mortgage payment. So you'd have a break-even cash flow. So the money partner puts more money up front, but then you're not having to worry about whether they have it 5-6 years from now. And you can still refinance down the road if we have lower interest rates to increase your cash flow at that point. So now that I have a strategy for how to make money on this property, I would go out to the people in my world, people I already know who happen to have cash, who hopefully have good credit, and who have the interest in buying a rental property, but probably don't have the time to do it on their own. They don't have the time to go find this deal and the time to manage it. And so they're looking for more of a passive investment. And so the partnership here is they're the money partner. They put up the money, the cash that's needed on upfront and on an ongoing basis. You're bringing the deal, you're operating the deal, and you just split it 50-50. So in the end, whatever cash they put into the deal, you're going to pay them half of that back whenever you sell the property or do whatever you're going to do with it in the end. Now, there's a lot of details about how to structure that and whether you get an LLC, whether you do a credit partnership. If you're interested in some of those details, let me know in the comments below, and I'd be happy to do some more videos on that in the future. But the point is there's some simple ways to structure this where the money partner wins, where you win, and you can either put either no money or maybe just a little bit of your cash into the deal, and both of you can profit. Now, I've spent a lot of time on this first example because I like learning with details. So I hope you find that helpful. And I also think this first example of finding a money partner, someone who has $100,000 to $150,000 of cash and who can work with you as a passive investor, is probably going to be the easiest to find of the 4 examples that I share with you. But you also might be thinking to yourself, is there a way I can do this deal on my own without a partner? And that's what I want to show you with the second example where you use a private money lender. Now imagine in this example, we have the exact same scenario where we go out hunting for properties, but we find a deal that's even better, the same exact house that we evaluated before, but you're able to get it a little bit cheaper at $300,000, even though the full value is $400,000. Now, I already know what some of you are saying in your head. Yeah, this is pretty easy, Chad. When you find a deal that's worth $400,000 and you could buy it for $300,000, who wouldn't want to do a deal like that? And where are you going to find a deal like that? So I know that's a challenge in all of our minds, and I want to refer you to another video that I did earlier this year called 4 Underrated Ways to Find Off-Market Properties. And the key there is you're going to have to look at a lot of deals before you find good deals like this. But if you want to do deals with less of your own cash, if you want to make more profit over the long run, it's worth learning that skill of how to find off-market properties. I'll have a link to that above me if you're watching on YouTube, or also in the video or podcast description. So to come up with the money for this deal, unlike last time where we went to the bank to get a loan and then we went to a private money partner for the down payment and cash we needed, this time we're going to go to a private lender and ask them to loan us $265,000, which means we're going to come up with $35,000 on our own because remember we had about $50,000 saved up. So we're going to make a down payment of $35,000 and the private lender is going to loan $265,000, and we're going to pay them a 6.5% interest rate for the next 10 years. And our payment to them is going to be interest only, which means we're going to pay them $1,435 per month. Now, if you remember our rental numbers from before, this is the same property that rents for $2,400 per month, and we have a $950 operating expense. So we have $1,450 per month left over to make our mortgage payment, which is just enough to basically break even paying our private lender. Now, you might be asking yourself, why would you buy an investment property where you have to put $50,000 of your cash up front and you make zero cash flow? Remember, you have different strategies for different properties and in different locations. This is a growth property that we already day one have $100,000 of equity because we bought this property below its full value. So theoretically, we could turn around and sell this property if we wanted to and make some kind of profit. But if you really want to build wealth, what my favorite strategy would be patient and hold this property just like we did last time until it doubles from what we paid for it. So maybe that's 8 to 10 years from now, we hold this rental property and now it's worth $600,000 instead of $400,000. And our wealth has grown by $300,000 because we paid $300,000 for it. And in the meantime, the rent over time has probably gone up as well. And so we're starting to make cash flow that we can put into our bank account as well. So for your $50,000 investment to turn into $300,000 plus cash flow, this could be a very good investment for you as the rental investor. But you might be asking yourself, who would want to do a deal where they loan you $265,000 and they make 6.5% while you're making a lot more money? And the answer is, this is someone who wants a very passive investment, probably somebody who has a lot of money, but they have lazy money where they don't want to do all the work to go rent the property, find the deal. They just want to maybe make a retirement income of 6.5%, and they get their steady payment each and every month. And most importantly, this is probably someone who understands real estate investing. Maybe they used to be a rental property investor, more active, and now they're just trying to live off their income. But they like the fact that they understand real estate. Here's a $400,000 property that they have a $265,000 loan on. That's a loan to value ratio of about 66%. Which for someone who understands real estate makes them feel very safe and secure because they have this single family house where if something happened to you and you stop making payments to them, they could foreclose on you, take back the property, and then either rent it out or sell it themselves. So the type of person who will loan money to you is someone who understands real estate, who wants security, and who wants that passive income. And this type of person might not just land in your lap, but if you go out and you start talking to other real estate investors, you go to local real estate meetups, you network online on places like Bigger Pockets, you go to real estate classes, you're bound to meet people who fit this profile. So far in the first two examples, we figured out ways to still buy properties with your $50,000 of limited cash by going to a private money partner, by going to a private money lender, and essentially bringing them a really good deal, something you've bought well below the full value of the property. But you might be thinking to yourself and have an objection, which is actually legitimate, that not every property will you be able to buy well below the full value. $300,000, $320,000, those are really good deals. But could you actually pay more for it and still make it work? So I want to share two more examples where we actually work with the seller to find financing terms that allow you to still make money and still be able to get into the deal with your limited amount of cash. So in this third example, we're going to go out hunting for deals again, and we find the exact same house just to keep things simple. But in this case, we find a seller who is a landlord. They've been renting this property out for multiple decades, and we connected with them directly through some off-market marketing. Maybe we sent them some direct mail, or we were driving for dollars and noticed a vacant property. And when we talked to the seller, we made them an offer at a lower cash price so they could get all their cash up front. But they didn't like our offer of $320,000 and they said that wasn't going to work. But let's say we also made them a second offer at a higher price of $370,000. But with this offer, we're going to pay the seller a $35,000 down payment. And then the rest of what we owe them, $335,000, they're going to agree to seller finance to us. And all this means is that instead of us going to the bank or to a private lender to get the money, they're just going to wait on their purchase price over time. And so we're going to make them a monthly payment. And in this case, we offer to make them a $1,412 monthly payment. And the terms of this seller financing is 3% interest for a 15-year period. Now, I encourage you to plug all this into a loan or an amortization calculator online. But the way this works is that we're going to still owe some money to the seller 15 years from now, which means we'll make one big lump sum payment at that time. But because we're making a $1,412 payment for the next 15 years, we're able to make this property cash flow. Because remember, it rents for $2,400 per month. We have $950 in expenses, and we have $1,450 in net operating income. So even though you're able to barely cash flow this property, I know some of you still have some skeptical voices in your head, and I'm okay with that. And you might be asking yourself, how can you pay more for a property? How are you going to actually make money on this? Which is an important question, by the way. But remember, the strategy here is growth and being patient. And so now because we can make a positive cash flow, we can afford to wait. And we have 15 years to wait in a good location with a good property. And a property that today we bought for $370 that's worth about $400,000, about 13 years from now might be worth about $740,000. And that's assuming about a 5% growth rate, and that may or may not happen. But the point is, 13 years from now, this deal is going to be worth a lot more than it is today. And we will have also paid down the debt to our seller. And in 13 years, it'll be about $225,000. So our $50,000 original investment will turn into well over $500,000 in equity about 13 years from now. And that doesn't count any of the cash flow that we probably made as the rent increased over time and our payment to the seller stayed the exact same. Now you might also be asking, why would the seller do this? And the short answer is most sellers won't, but there are sellers out there who have a situation that would make sense for them to work with us with seller financing. And I'll give you an example from my experience because I've bought many properties just like this. And I've found sellers who've been renting their properties for a long time. And what often happens if you're a long-term landlord is you keep your rents a lot lower than the market value. So in our case, it's very possible that this landlord was renting their house for $1,500, $1,700 per month. And then eventually they just got tired of managing the property. They're ready to transition out of the landlording business. So if you can build trust with this person, show that you're a trustworthy person, and offer to make them a down payment that gives them some cash up front, and then they can make a monthly payment that's comparable to what they were getting from the rent from the property after their expenses. This is a way for them to go from being a more active landlord where they're having to think about the tenant and when it turns over, to just getting a passive monthly payment of over $1,400 per month every single month for the next 15 years. So that passive income I found to be the number one benefit, the selling point to why somebody would do that. But the other benefit you have to understand is that this is a person who understands real estate, who's owned real estate for many decades. And yes, they could sell this property, cash it out, and go put their money somewhere else, but they know this property. They've owned it for a long time. So the feeling of security, knowing that if I stop making payments to them, they could keep my down payment and they could take this property back, is actually a comforting thing for people who like real estate. They would rather have that than have their money somewhere else. And then finally, there's often a tax incentive as well. So if this person bought this property many decades ago for under $100,000, and today they're selling it for almost $400,000, they're likely to have a big tax gain on that sale, which means they'll pay capital gains tax. So this is something that you should encourage them to talk to their own CPA about. But you can point out that they would have a big tax hit. And then if they sell it to you on an installment sale, which is another term for what seller financing is, that they may be able to spread out the tax costs that they have over many years. And that might be able to help them out from bumping them in to a higher tax bracket. Now, again, I don't recommend you giving tax advice. You work with their tax professional, but you can point that out, and that can be an additional benefit for them. So if this idea of buying with seller financing is intriguing to you, but you want to understand more details, I have an additional video where I went into a lot of detail about how you buy with seller financing, what it looks like, how the transaction works. You can find that video above me here if you're watching on YouTube, and also it'll be linked in the podcast and YouTube description below. In the fourth and final example, I'm going to address an objection that many of you might have had with example number 3, which was in order for us to buy that property with seller financing, that owner had to own that property free and clear of debt. They had zero debt on the property. Now, there are a lot of people out there, believe it or not, who own their properties free and clear, especially if they've owned it for several decades. I've heard numbers like 40 to 50% of property owners. It just depends on the location you're in. So there's plenty of deals out there like that. But there's also a lot of people out there who might want to sell a property and you might want to buy their property, but they owe a mortgage on the property. So is there any scenario where we could still make it work with our $50,000 in a situation like that? So I'm going to take us again back out into the field looking for deals, and we talked to a lot of property owners, and we happen to find a situation with the exact same house, just to keep things simple, where this property owner is actually behind on their payments. Let's say they lost a job or they had some medical issues, but the point is they can't make their payments and they're behind on their payments. They owe about $10,000 in what's called arrears. So they need $10,000 to bring their payments current. And so they've decided that they just want to sell the property. They're going to move somewhere else and rent for a lower amount or move in with family or something. And so they just want to sell the house, but they don't want to lose all of their equity. They don't want to let it go to the foreclosure sale because they owe $300,000 on this property, which they're asking $400,000 for. And it's worth about $400,000. So let's say we make an offer like this. We say we can buy your property, but here's the way we want to buy it. We'll make you a $10,000 down payment, which will help you bring your payments current, and we'll buy your property subject to the existing mortgage. Now, I'll talk about that a little bit more in a moment, but essentially we're going to take over payments on the mortgage they already have, which in this case is a 4.7% interest loan. It still has about 28 years left on the loan, and the payment is $1,600 per month. So again, our offer is to come up with some money up front, some cash to help them bring it current, $10,000. We're going to take over payments on the $300,000 mortgage, so that's $310,000, but we're going to pay them a total price of $370,000, but the remaining $60,000, in order for us to make this deal work, we're going to offer them this, that they'll carry that back as a seller financing mortgage, sort of like what we did in the last example. But in this case, we're going to have a 0%, zero payment seller financing mortgage. And the reason is we can't afford to pay them any monthly payments. Their payment is $1,600 per month. We're going to take over payments on that and rent the property out. And if you remember, this property, same property, produces $2,400 in rent, $950 in operating expenses. So we have $1,450 left over to make our mortgage payment, which means we're going to have a little bit of a negative cash flow, $150 per month or about $1,800 per year. And we've done our homework on this property. We want to own this property and we believe over time it'll get better. So if we're able to get into it with a pretty small down payment, $10,000 is what we're having to come up with up front. And if the seller's willing to wait on the balance of their equity, and let's say for a 10-year period, we say if you'll wait for 10 years or sooner if we sell the property, we'll give you your additional $60,000 so you don't have to lose that money if it went to foreclosure. So I know I said a lot there and I talked about buying subject to the mortgage. I have once again another resource. If you want to check out a video I did, it's a long time ago, so it's not a high quality video, but I talked about how buying subject to the mortgage works. There'll be a link above me in the YouTube video and also below in the podcast and YouTube description. But this is a strategy that has a lot of nuances. One of the challenges and one of the things you have to know about is that most mortgages have a due on sale clause. So this mortgage company could call the loan due and say you have to pay the entire balance off right now. So you have to be prepared with a backup plan in case that happened. And so maybe you'd have to go to a private lender, maybe you'd have to go to a money partner, but there are a lot of investors and you might be willing to be one of those investors who's willing to take the chance, the small probability that the loan would be called due. Because here again is the benefit. We've talked about the benefit to the seller. They're able to preserve the equity they have in the property. They're able to sell it quickly without having to put it on the market. They're able to move on from the situation and salvage a bad situation. But for you, you're able to get into a property with a lot less down, $10,000 cash down. Maybe you had to set aside the rest of your $40,000 for closing costs, for maybe fixing up the property a little bit more, for a cash reserve, just to make sure you have some cash in the bank. So you still had about $50,000 you had to allocate to this property. But we've again chosen this property deliberately. And if we can hold the property for the next 10 years, maybe this property that was today worth $400,000 is worth $650,000. And because we paid that mortgage down, maybe to $235,000, we've now built over $400,000 in equity and we started with $50,000. So we've 4x'd our original money that we invested, and we might have also made some cash flow over time as the rents went up on the property. So the point of this entire video and these 4 examples I've shared with you is that if you have a limited amount of cash, whether it's $50,000 or whatever the number is, you can still do deals. But you have to think a little differently. You've got to think about O.P.M, other people's money. You can use private partners. You can use private lenders. You can work with the seller on seller financing. You can work with the seller to buy a property subject to the mortgage. I think about these like a toolbox where you're going out into the marketplace, you're looking for good deals, and you're bringing your toolbox of financing tools. And depending on what the situation is, you don't know if it's going to be a seller who'd be willing to do seller financing. You don't know if they want their cash. You need to go get a private lender, or maybe it's a situation where you could buy subject to the mortgage. Your job is to be a deal maker, to be a crafts person who understands these tools, who knows how to use them, and then who goes out there and works with those tools and makes offers to people to try to help solve their problems. So I hope that this gives you some hope for 2024 that you can go out and do some good deals. I'd love to hear from you in the comments below. Let me know if you have any questions, if you have any comments about what I've covered here. And remember that if you want to run the numbers yourself on your own rental properties, I have a simple rental property calculator. It's a spreadsheet that you get for free, and you can get that down below in the video description or the podcast description. And then please plan to stick around. I have new episodes that come out every Monday. I publish them here on YouTube. I publish them on the podcast. You can find me on any podcast player just by searching for Coach Carson. It's the Real Estate Investing with Coach Carson podcast. And this is a show all about helping you get out of the financial grind so you can do more of what matters. My name is Chad Carson. You can also call me Coach. I'll see you in the next video.